Hello, everyone, and welcome to Western Wealth Capital's webinar on our latest Arizona investment opportunity. My name is Eric Lobson, Vice President of Operations with Western Wealth Capital, and I'm pleased to have the chance to talk with you today about our 27th acquisition in the greater Phoenix area of multifamily apartment building and investment opportunity for Canadian and U.S. investors. Each of our Western Wealth Capital presentations start with this slide, which we think is a very important concept that we like to share and discuss with our investors or people that are interested in our opportunities. What this slide is showing is the long-term real estate success formula, as seen by many experts in the industry. And the premise here is that as GDP and growth occurs, job growth occurs, people go where the job growth, so the population grows there. That population growth presses a demand on rental properties, so increases that demand, and of course with an increase in demand there's a decline in available places for people to live, creating a scarcity which drives up rents. So that increase in rents then ultimately increases the demand for purchasing properties of these types, because there's and then further drives the overall value of the property. So any investor seeking to invest in real estate is looking for this type of growth path and these types of growth factors, and we see this in abundance in Phoenix, and we'll explain why we see that in the following slides. One of the first parts of that growth curve is the job growth. So there are a huge number of companies migrating to Arizona. One of the principal reasons for that migration is the general low cost of living in comparison to some other large cities in the U.S., in particular neighboring San Francisco and other parts of California. Tremendously high cost of living. When you run this slide or this tool presented by CNN Money, you can see that a person or a company paying an employee for $150,000 per year to work in San Francisco could pay an equivalent employee to maintain their cost of living in Phoenix, Arizona for $86,000, so almost half that cost. So that's the low cost of living, the lower cost of needing to pay employees for their living and sustaining a high standards that they're looking for. Is one of the factors that's driving companies to Arizona, and people like to live there from the great weather most year round. These are example of many of the companies that are migrating into the Phoenix area. I'm sure you'll recognize many of the logos. Some huge companies like Amazon, Intel, Motorola, Apple are just some examples that are moving more and more of their headquarters or facilities into the Phoenix area. Another key factor that's driving companies here is its proximity to so many parts of the U.S. Over 65 million consumers are accessible by truck overnight from this Phoenix hub. So we're seeing that job growth and the projection, the population growth is following right alongside, because people go where the jobs are. So Phoenix is growing at 3 times the U.S. national average of population, and so this is continued and projected to continue on to 2030 in these projections that we've got here. It's also the highest predicted job growth market in the U.S. So that's another factor, again, that's just continuing to grow the job and population appeal to the Phoenix market. And yet again, here's another projection from Moody's Analytics showing that it's actually the highest projected in the future as well in terms of job growth. So as we saw in that growth curve, exactly as predicted, there's been a steep decline in vacancies in the Phoenix area, and again the projections are for this decline to continue. So there's a huge demand on rental properties, and therefore the rents are also on a major upswing in the metropolitan Phoenix market. You can see it's averaging over 6% on a year-over-year basis in terms of increasing rents. Western Wealth Capital follows a very consistent investment model. We look every time to acquire a property that we can purchase at an undervalued price. That's both in terms of the current market price, so we look to get a discount off of what would be considered the market valuation for a property. In addition, we look for one that's being underoperated, or usually there's a distressed owner or someone that's a checked out owner, or just fully not tuned in owner operator that really understands the market and the abilities to drive value in a multifamily asset. We also then look to add value in 7 significant ways, which I'll discuss in a little bit more detail here in a moment. And once we have added that value, or as we add that value, another key part is to manage the cash flow and growth, as ultimately these properties are valued based on the net operating income of a property and the ability to grow that. So there's 7 main ways in which we look to add value to a property, and anyone that we're considering acquiring has to have at least 3 of these in a very significant and meaningful way. In most cases, this is what might seem simple, but it's adding or installing washers and dryers into the units in these multifamily units. Each one, and we've installed over 2,000 to date, has consistently been able to get $50 per month per unit additional rent, which goes straight to the net operating income growth. So that's a meaningful way in which we look to add value to every property we seek to purchase. Another way is through doing interior upgrades, which I'll show you in a minute, and that drives a big factor of the appeal, driving value for the property. Additionally, signage, we look to ways we can improve the signage in the property to drive more prospective residents. That increases demand and again helps to push rents up for a property. We seek properties that are nearby excellent schools and has great appeal to families or teachers and faculty at these schools. We seek properties that have good traffic volumes and great exposure to high volumes of traffic each day in terms of vehicles or other pedestrians or eyeballs that would be interested in seeing our signs and interested as prospective residents. Many times we find owner-operators that are just, as I mentioned, either distressed in some way or looking to they found that they've gotten themselves in over their head in terms of their knowledge level of how to direct the operations of these properties, and want or need to cash out of these properties, so they're motivated to sell, which helps us to get a better price. And then again, they're often not managing the rents and the rent roll very effectively, which is another tool that we look to be able to have in our chest as far as how we increase value for each of these properties. The general partners of Western Wealth Capital have tremendous experience in this industry and in applying these value-adding programs. Janet LePage is the co-founder of Western Wealth Capital and has flipped over 52 houses in Phoenix in the past, or in 2 years, or earlier in 2010, 2011, and acquired her first multifamily property in Phoenix in 2011. And that's when she connected with Dave Steele, who has over 25 years of experience in real estate investing, not just in Phoenix, but across other markets in North America, both US and Canada, and overseas in China. And so Janet and Dave co-founded Western Wealth Capital in 2011 to specifically go after opportunities to follow this program that I'll outline in a little bit more detail. But the Western Wealth Capital approach has been consistently applied now in the 25 acquisitions we've completed to date, with 2 more currently underway, and this one I'll tell you more about in a minute, called Sunpointe, which is our current investment opportunity. We have a team in Phoenix that looks after our operations on a day-to-day basis and looks after the properties. We're currently working with 2 property management companies. They are third-party companies, which gives us great ability to have influence over how they're controlling their operations. We have a bit of competition between them to make sure that we're getting the great prices, but also we have great scale with them both in terms of being, and that helps us get lower costs overall for many of our personnel, as well as great buying power for any types of materials and supplies that we need to acquire. So these two companies are very excellent property management companies, both which are headquartered in Phoenix and look after our day-to-day property operations. We also have two asset managers that are located in Phoenix and oversee the day-to-day operations of our property management partners to ensure that the business plans that we've put together for each of our acquisitions are being executed with excellence. So our current opportunity is called Sunpointe Apartments. It is our 27th acquisition, as I mentioned. It is currently under contract and is set to close at the end of January of 2017. It's an excellent opportunity in the Southwest Valley of the metropolitan Phoenix area, which is a region that's undergoing tremendous job growth, which I'll explain in a moment. It's a very nice property from the exterior, which is great because it means that we don't have to invest a lot in the exterior appeal, although we do have some plans as far as signage is concerned and a few other things that will help to drive a further appeal to this property. But there's tremendous opportunity to add value from an interior perspective, which I'll talk about more in a moment. As I mentioned, it is in the heart of the Southwest Valley of the metropolitan Phoenix area. We do have other properties in this region. You can see on this slide, you hopefully can notice the Desert Wind Apartments logo. This is one that we acquired back earlier in 2016, which is just down the road. So another way that we've gotten to know this part of the market very well. There's a lot of logos on this screen, many of which you'll recognize, but it's important to note that when you see Amazon and PetSmart, especially, you're probably thinking that these are the stores, but actually they're not. One of the things that's really driving growth of jobs in this part of the metropolitan Phoenix area is its great access to the major highway systems, including the I-10, which is a direct route into California. So a lot of companies are setting up their distribution hubs and major distribution facilities right here in the Southwest Valley. In fact, Amazon has got over 3,000 jobs just in this fulfillment center right here, which is right across the street from Sunpointe Apartments. And actually, it turns out that 20% of the residents currently living in Sunpointe Apartments are actually working across the street at the Amazon fulfillment facility right there. So huge growth in this area in the industrial and distribution fulfillment side of the economy. And as you can see from this slide, just tremendous number of jobs within a very short distance of this property. So a great employer, brings a lot of stability from a resident and economic standpoint, and also a lot of growth from a value-adding standpoint. In addition to all of these jobs that are right here, what this slide is calling out on the high volume of traffic passing by this property. This is one of the most extensive, or one of the highest volume traffic areas that we've seen in our portfolio. 24,000 cars per day drive along McDowell Road here in front of the property. But 172,000 cars also drive along the I-10. So we do have plans to put signage that will attract visibility to both sides of the property and capture the eyeballs of those high volumes of traffic going by each day. And this is another slide that helps to show where the access to all these fulfillment centers are. I did say that Amazon was across the street. It's a little further away, but there is this O'Reilly facility right across the street as well. But a great job market here. So Sunpointe is over walking distance to 6,000 jobs, and as you saw on that last slide, there's over 50,000 jobs within 3 miles of this property. We love the traffic here, and that's going to help us to boost demand. And in this great industrial fulfillment sector, job growth story is another really great factor about this property we like. The rental growth in this market, as you can see here in the last year, it was 8.4% increase year over year in this particular pocket, which is interesting compared to the 6.5 or 6.4% average across the Metro Phoenix area. So as you can see, this is one of the one of the standout pockets of Metro Phoenix. So you'll see with Western Wealth Capital Opportunities a very consistent approach to our business plan, and I'll outline the details, the high-level details of this here. And if you're interested in learning more, we can share with you the executive summary for this opportunity, which provides more information on the business plan for this opportunity. We're acquiring the property for $10.8 million. We did get it for roughly a $200,000 discount immediately from what a previous seller had negotiated, or previous buyer rather, had negotiated with the seller. However, unfortunately, that previous buyer ran into some health issues and had to abandon the deal, so the seller was really in a bind to find someone to acquire the property, and the timelines that they were working with knew that we were interested, as we had been 3 or 4 months ago, with acquiring this property. So we were able to get a good price in order to effect a very fast close on this deal. So we did get a discount off the market price for this property right off the bat. We have a mortgage on this one of $8.37 million. We're putting $1.47 million in terms of capital improvements and the acquisition closing costs to acquire this property. So at the end, we're looking for raising $3.9 million of equity from investors to complete this transaction and affect the value-adding program that we'll go into a little bit more here. Our goal in each of our business plans is to double our investors' equity within 5 years, and that's what we start with in terms of our objective when we look at the financial model, which we are very careful to apply what we believe are conservative factors in terms of our modeling, which I'll outline here. As I mentioned, there's always at least 3 main factors that we're looking at for appreciating the value of a property. So this will take you through what those 3 factors are for this particular opportunity at Sunpointe Apartments. In this case, there's the largest loss to lease that we've seen in any of the acquisitions that we've done to date. What we mean by loss to lease is that the current market rents for the building are at a certain level above what the average or what each of the residents in existing leases are paying for their apartments. Or said another way, someone that's just rented Unit 101 at the current market rate of say $900 per month is paying that. Someone in Unit 102 that might have rented say 8 months ago might be paying $750 per month. So that $150 difference is the loss to lease, and there's a tremendous amount of that loss to lease where there's people paying currently under market values for their rents. So actually, here's another example of what that might be. Some different figures than what I just mentioned in my example, but you can see here that Unit 201, 202, 203, and 204 all have vastly different rents, and in this case, they're all identical units. So what this means in this property is there's $187,000 of additional net operating income to be had by normalizing rents, or bringing all of them, letting the current leases expire and bringing the renewals or new residents in at the current market rates. So when we perform that, that adds almost $3 million of value right off the bat in terms of the valuation of the property. The next piece that we're doing in this business plan is performing what we call gold standard interior upgrades to 100 units within the property. The current interiors, this is actually from a different property, but a very similar type of layout. The current interiors look similar to this. We put on some painting on the cabinets. We put in some nicer looking appliances and some new handles on the counters and things to make it look a little more appealing and fresh. And that is consistently enabling us to increase rents on these units, which are experiencing very high demand for these types of improvements. Don't cost a lot for us to put in place, but make a big difference in terms of the valuation of the property. Excuse me. So in this case, we're installing 100 interior upgrades, in this case, we are also projecting a $50 per month increase on each of those units, which we do the upgrade on, which increases the net operating income of $60,000 and the value of the property by almost $1 million. The other third piece that we're doing on this, a major value add program, is installing washers and dryers. In this case, we're going to install 33 washers and dryers. Several of the units already have washers and dryers. That's part of the reason for this fairly low number in proportion to the total number of units in the property. But it's still going to have a big added value effect. And in this case, almost $20,000 of annual net operating income growth, which is representing just over $300,000 in value for the property. So as you can see here, we've accumulated through almost $4.3 million in value from this value add program, which is more than double the objective of which exceeds the objective of doubling investors' equity within the 3 to 5 year time frame. Not factored in this simple business plan in front, but we've also modeled an increase of rents of 3% per year, which again we believe is conservative compared to the market average in the last year, year-over-year increase of over 8%. So ultimately, on the $3.9 million of equity we're seeking to raise for this project, this business plan outlines a 110% increase on equity. So when we put it into our financial models for this, you can see here we project a purchase price, or we're acquiring the property for $10.8 million, and we project at the end of year 5 that the property will be worth a little over $17 million. The cash flows on this property are very strong, and our projections are for continued strength in this, ranging from free cash flows in the first year of operations from 9.4%, as high as 14% in year 2, and further, continued strength in year 3 through 5. The reason for the dip in terms of cash flows in year 3, 4, 5 is that we've got an interest-only mortgage that we have secured for the year 1 and year 2 of this. So in year 3 through 5, we'll be having a principal pay down included in our mortgage payments, which decreases the cash flows, of course, a little bit, but still very strong across the 5-year horizon from our projections. We also have a unique financing program that we've arranged with our lenders, which enables us to get, it's essentially a refinancing, but it's called a supplemental financing program. So to the extent that we're able to increase the net operating income and therefore the value of the property over the business plan time frame, we are able to get additional proceeds from the lender, which we then use to return the capital to our investors. And the model for this one shows that we expect to be able to return a little over $2.3 million in year 2 to our investors. And by the time we get through this program at the end of year 4, we expect that we'll have been able to return 93% or up to 93% of our investors' capital by year 4, yet still putting our investors in the position to benefit from the overall share of free cash flows as the program continues to enroll. When we model what a year 3 or a year 5 exit or sale of this property would look like, and factoring the costs of closing and other factors, ultimately we expect that limited partners or investors would be able to realize a 24% annualized return on their investment, both on a year 3 or a year 5 exit plan. I did touch on the refinancing versus supplemental financing a little bit, or explained about the supplemental financing program. It is different from a refinancing in some significant ways, and principally that ultimately is cost. At the end of the day, a supplemental financing costs between $20,000 to $30,000 as compared to a full refinancing of $300,000 to $550,000 approximately. So it's a much lower cost way of doing a additional financing round by pre-negotiating this with our lenders in advance and being able to achieve some milestones that they have worked with us to establish to get further value out of the property and returned back to our investors. Here are some shots of the property, just the grounds. Of course, there's a very nice pool. Grounds are nicely maintained. The clubhouse and leasing office is very presentable and very nice. We'll do some soft updates to this to make it even more appealing. You can probably noticing or may notice the pool furniture. We're going to do some updates to the pool furniture to make it more appealing and more modern. So in summary, the Sunpointe investment opportunity, we expect to be seeing cash flows between 9.5% to 14% over the 5-year period. We expect to be able to return up to 93% of our investors' capital within 4 years, and are estimating annualized returns as high as 24% on a year 3 or year 5 exit. Some key benefits to investing with Western Wealth Capital are outlined here. Because of our track record and performance with real estate brokers and our lenders, we've been able to get access to many of the best deals in the Metro Phoenix area. They often bring us deals that are off market before bringing them to market because they know that when we're interested in a property, we've got an ability and a track record of closing on these deals. Our size has enabled us to get some great economies of scale and buying power, both with our property management partners as well as other vendors that are working with us, and that helps us to cut costs and overall increase value for our investors. The general partners provide the mortgage guarantees on the lender side, and therefore our limited partners are not subject to the liability associated with mortgage guarantees. That's handled by the general partner. We do have some unique and exclusive financing options, as we mentioned, through the supplemental financing program. And we've got a very experienced team that's managing the investments and managing the strategy of the properties and the day-to-day operations. The structure that investors participate in is a limited partnership structure. So for Canadian investors, they invest in a Canadian-based limited partnership, which then itself indirectly acquires the US-based property. I'll just explain on this one too. If US investors that might be interested in participating, there's a similar structure for US investors whereby there's a US limited partnership, which again indirectly acquires the assets and the real estate asset in Phoenix. A second way that Canadians might be interested in participating in Western Wealth Capital opportunities is through the Arizona 88 Opportunity Fund, which is an RSP eligible and deferred savings plan eligible fund. It's a bond fund that has to date participated in several Western Wealth Capital limited partnerships. It acts as essentially as its own limited partner, or as a limited partner that participates like other limited partners in Western Wealth Capital opportunities. So investors that are placing funds through the Arizona 88 Opportunity Fund actually access multiple Western Wealth Capital deals using that venue. A few highlights on some past investment opportunities that we've been working through to date, and overall with Western Wealth Capital overview. So as mentioned, this is our 27th acquisition. We've acquired over 4,000 units to date. Purchase value on those is over $300 million. We've raised over $100 million in equity, have over 250 active investors at this point. In the last 3 years, we've distributed over 8% annualized cash flow distributions to our investors, and have completed 4 supplemental financings in the past 12 months, 5 in total in our history, with more currently underway at this moment. All of this amounts us to being the 3rd largest multifamily owner in the Phoenix metropolitan market. These are photos of each of the previous acquisitions as well as the 2 current ones that are underway. Sunpointe at the bottom of this photo collage. Some of our earlier investments that have had the supplemental financings are highlighted here. So Edgewater we acquired in June of 2014 and have now returned over 65% of our investors' equity within 29 months. Scottsdale Haciendas was acquired in November of 2014, so 51% of equity within 24 months. Villa Serena we acquired in August of 2014 and have now returned over 73% of equity in 28 months. Brookside, April of 2015 was acquired, 42% of equity returned in 19 months. And Oak Ridge was acquired in August of 2015 and now has returned 29% of equity within just 15 months. And this one is one that's just in the final stages here of the refinancing program, Maryland Gardens. When that is completed, expected this month of December, there will be 64% of investors' equity returned in 21 months. We've also sold 3 properties so far. This one here, Cimarron Village, was just sold in September and has yielded over 30% annualized returns to our investors. Casa Mirabella just sold in November. Is 4 years and 1 day later, and it was returning over 30% again of annualized return to our investors. The third one that's not on this slide here that we did sell a couple of years back was Setting Sun. So for Sunpointe, we're seeking, as we mentioned, $3.9 million in investor equity. We are requesting funds by January 24th of 2017, that should say. And here's again the summary on the business plan of how we believe we'll be able to double our investors' equity within the 3 to 5 year plan. One other thing I wanted to bring to your attention here is we are doing a tour of discovery of Phoenix on January 14th, 2017. So what that is we're getting together with a group of investors, both existing investors and interested investors in Phoenix, and we're going to tour them around some of the very interesting submarkets of the metropolitan Phoenix area. We'll show you some of the properties. We'll show you some of the key job growth areas and major investment in job growth that's going on in Phoenix. And we'd love to have anyone interested in participating to come along. If you are interested or would like more information, please email info@westernwealthcapital.com or talk with your Western Wealth Capital representative that invited you to this webinar today to find out more information. So with that, concludes the formal part of the presentation. I'd like to open up the floor to any questions. I do see a couple here already on queue, so I'll answer those. And just if you do have some questions, please put them, either you can type them into the meeting console here, or there's a little icon that you can use to raise your hand, and I'll be able to open up your microphone to handle any questions. So the questions that have already been typed in here is 2. One is why do we want the high traffic frontage? The reason is we want to be able to attract a high volume of potential residents into the property. So we're careful how we select that frontage and the exposure of the property to the traffic. On the one hand, we want to make sure there's a nice private and quiet area for residents to live in, so they're not faced with the exposure too much of the traffic. Yet at the same time, we look for ones that have a great sort of storefront, if you will, visibility to a high volume of vehicles or other traffic, so that we can make sure we've got some great signage, great curb to suite appeal to entice people to come have a look at what the living opportunity looks like in our buildings. And if we can drive high volumes of traffic, that helps to further increase rents in the because of that high demand for the living accommodations. The other question that was asked is why was the former owner selling? They have a particular focus themselves in the California market. This was one of their remaining properties in Arizona and Phoenix, and they wanted to consolidate all of their operations into the California market. So that was what their primary motivating factor was, to organize all of their portfolio in California. question here is to explain the supplemental financing in more detail. So how that works is we work with our lender at the upfront part of the structuring of the loan, and we show them in great detail our business plan for the property, and they understand that the property will be valued on based on the net operating income divided by the cap rate of the property. And what they use is the cap rate that's in place at the time we acquire a property. And so really the primary thing that they're looking for is how much can we increase the net operating income, which therefore drives the overall value appreciation of the property. So when we show them our business plans of how we will meaningfully increase the net operating income and therefore the value of the property, they agree to fund us the full amount of the value of the property on a year 3 or year 5 plan, and then they advance us up to 75% of those funds at the beginning of the program. So that's the initial loan. As we demonstrate that we are making the progress we plan to or exceeding the net operating income growth, they reassess the value of the property at that time, which we can apply for the release of further funds each 12 months. And at that point, they will forward us or advance us the additional value appreciation that's being recognized through that NOI growth, and that provides us access to further amounts of that initial loan that was initially negotiated. So those proceeds, then in turn, we distribute the majority of those to investors. In some cases, we hold a little bit of it back, potentially for reserves or other further capital improvements to help affect a further value increase of the property. But the primary factor here is to return as much of our investors' equity as possible, or investors' capital as possible, so that they can use that capital to reinvest in other opportunities as they see fit.
Hi, Eric. It's Cynthia.
Hi, Cynthia.
I'm just looking at one of the questions here. Talk a bit about disposition. What are the risks? And just to maybe shed some perspective on what the risks are in this investment and how Western Wealth Capital, I believe, has mitigated a lot of them.
Sure. So, I think one risk, a major risk always of interest is around the market, and I think we've explained the market risk and what we see of that in fairly well. But it's really about what we think is mitigating factor on the market side in Phoenix is that tremendous amount of job growth that's taking place currently. But we also think that will continue for several factors, and being partly the low cost of living, but also the investment that's currently and recently gone on in Phoenix to build facilities for that job, to help support that job growth. In other words, companies like Amazon and Apple and State Farm is a great example where they're in the middle of building facilities that they've about sort of halfway through or greater in terms of the actual construction of these facilities for jobs that have not yet come, but they are bringing employees into Phoenix to fulfill those jobs and to utilize the spaces that they're creating. So they have those jobs unplanned, they have many of those jobs in hand, and those jobs are coming to Phoenix. So we think that's going to help to insulate the Phoenix market and continue to bring the job growth that's being projected. Some of the other factors from an investor standpoint, the risk mitigation side from a mortgage liability and any of the associated underwriting risks of a mortgage are taken on by the general partners, so that protects the limited partners from any risks associated with the mortgage guarantee. And really, so the main risk for investors ultimately is the amount of equity that they've put into the property is the potential amount that's at risk. But the other factors that we think are helping to mitigate the risk is that we believe that the factors that go into our models are very conservative, and we're actually seeing in many cases the rent growth exceeding our projections, or our models rather, um, and so we think we've got a conservative model here in place.
And just to touch on the investor's risk, as you're paid out your equity through the supplemental financing program, obviously your risk to capital loss is mitigated. Again, I've worked in the industry. My name is Cynthia Asen. I have a lot of clients online right now, and I've worked in this industry 20 years and have not seen this type of program that actually pays out the equity so quickly, and while clients still retain their interest.
Thank you, Cynthia. Any other questions at this time? I don't see any coming in, so happy to take more questions offline if anyone has them. Please do either ask your Western Wealth Capital representative that invited you to this webinar, or reach out to us directly, and we'll attempt to answer your questions. And if you are interested in participating in the Phoenix Discovery Tour in January, we'd encourage you to do that. We are looking for more people to participate, and we've had some great interest there, so we'd be glad to take you or meet you in Phoenix and take you on this tour.
There's a couple more questions, Eric. Does this incur U.S. tax liability? Yes, every investor is required to file a U.S. tax return. Western Wealth has arranged, is working with a cross-border specialist that has a very efficient way to file on behalf of our clients, and a very inexpensive option, and he's very easy to discuss or engage with. And also, what is the minimum investment? The minimum investment is $25,000 US. Any legislation that prevents raising of rents? Not currently.
Right. That's one of the things we like there, is that contrary if you're used to Vancouver or many other markets where there are some very strict restrictions on rental increases, there are currently none in Phoenix, and none that we're aware of coming down the pipeline either.
Is it only personal, or can it be done through our RSP? Yes, there is an RSP option. It can be done personally through the LP or through a corporation through the LP. And then there is an Arizona 88 bond fund that allows people to invest using their RRSP. What percentage of the profits go to the limited partners? The waterfall, or the profit share, is set up so 35% is general partners, 65% to the limited partners, and the profit share only happens after the limited partners have all their equity repaid. I think I answered the last one. I think the investment is, can it be personal, or can it be done through RSP or Canadian corporation? Yes to all three of those options. It's just a different entity, or a different, it's a bond fund that you're investing using the RSPs. Will you be sending bundle on possible investment scenarios? I think we should open up the line. It's Russ or Russ. I'm going to open up the line and let you ask the question, because I'm not sure that I understand what you're asking. So I'm just going to unmute you. Sorry, can't talk. Whoever, just reach, we can take this offline and maybe ask the question, and we'll get the answers for you, because I'm not sure. Will you be sending a bundle? Well, we have the limited partnership agreement and all the documentation that is available for you to review, as well as the executive summary. So we will be forwarding that to people that attended the webinar. Good, that answered the question. Any more questions? Any limitation to Quebec residents? Eric, I'll let you answer that. You're more familiar.
Um, so yes, there is, and so that's a great point. Though overall, I should have mentioned far earlier in the presentation that that the investment opportunity is available exclusively to accredited investors, unless you're working through the Arizona 88 Opportunity Fund. And so, if for Quebec residents, we have arranged with an exempt market dealer that does enable us then ultimately to accept accredited investors from Quebec into the opportunity investment opportunity. So it's a little bit more work, although it's actually a very easy process. But we do need to involve the assistance of this third-party exempt market dealer to help facilitate the investments. So it is available.
Great, good questions. Thank you everyone for attending. And if there's, Arizona 88 Bond Fund can be purchased through Olympia Trust. Yes, that's the only trustee to date that will accept the Arizona Bond Fund. Correct, Eric?
Yes.
Will I get more information from email you send after? Yes, we will be forwarding the documentation executive summary, and this will also be recorded. So if people want to listen to it again, that will be available. What would rampant inflation do to this project? Rampant inflation is great for real estate. Real estate's a hedge against inflation, so with rising inflation, usually real estate follows suit. So your property would be worth more money. And in that event, real estate would be less available to people and probably create more renters, so greater demand. Perfect. Well, thank you very much. Another question, Eric, you might want to answer this. How would rising interest rates affect the mortgage payments?
They would.
Sorry.
Okay. Yes, the rising interest rates would affect mortgage payments. Of course, the most are we do work on variable rate mortgage arrangements, so that would increase the payments.
And Eric, how does, I mean, Janet talks about this. I've had that question before, and she has, you know, I don't want to answer because I can't quite remember that. But she's really nimble.
Right.
She's very aware of what's, yeah.
Right. Yeah. So we're constantly monitoring interest rates, of course, and our variable rate loans are actually based on LIBOR and not typically the straight Fed rates. So we do look at the LIBOR changes, which are typically also impacted generally by inflation too. So we're watching that closely. The reason we like the variable rate mortgages is that it does give us tremendous flexibility in terms of managing the properties, and particularly the exit timing of the properties. So and finally the refinancing or supplemental financing program. So it helps us to act very much more quickly and overall lower cost of interest than what if we were to lock in at an interest rate now or in the times that we have projected in the future as well. So we do like this as a lower cost option and a far more flexible option for using the variable rate mortgages.
And also looking at the bond, the 10-year bond, you can usually peg what's going to happen to interest rates. So overall, globally, interest rates, there is not a lot of talk about rising significantly higher interest rates. It just would upset a lot. It's a greater downside for a lot of countries. So there is some talk that the U.S. will be seeing inflation. However, we don't think it's unmanageable, and we're not overly concerned with rapidly rising interest rates like we saw in the late 70s, early 80s. Great. Looks like there's no more questions. Thanks, Eric. Thanks, everyone, for coming.
Yeah, thanks all very much for your participation, and please do let us know if you want to participate in the discovery tour, and we'll be sending you follow-up emails to see if you have any other information requirements in the near term. Thanks again.
Bye, everyone.